Back. Today we're looking at another Financial Times for Schools article entitled "The Fed Risks Reacting Too Slowly If Inflation Keeps Rising." And you can see here I have added the link for you. So I think there are 5 questions here, and I'm just going to talk through some of the things which you may wish to include in your answers. So, with reference to chart 1, compare the recoveries and global output for 2020, 2009, 1991 and 1975. So it's an interesting chart which I've just cropped here out of the Financial Times out of the article, and you can see it's showing a number of recessions, and the recovery is forecast to be one of the strongest since the Second World War. You can see that this is an index number, and it's showing the pace of recovery, so sort of the percentage increase in growth of the economy, the UK economy, of course, this is, and the number of years along the x-axis. So you can see there 1975 output is just about, is it 14% above where it was 3 years prior, and coming in very close behind it on 2020 there. So forecasting after the 2020 recession, in about 3 years' time, we, as in the UK economy, will be approximately 14% larger than it was at the trough. It makes reference to the trough of the recession. Interesting just to consider some of the causes of the different recessions which are highlighted there. So obviously the 2020, it's the global pandemic. In 2009, we were thinking about the global financial crash and the financial crisis. And then thinking way back, of course, before your time, if you're watching this from school, 1991, which is, I remember doing my A-levels at the time, and the recession then was a result of the hangover from the sort of the 1980s boom, the era of the yuppies, the stock market, the flash cars, all came tumbling down, unfortunately, soaring inflation, very high interest rates at the time, which resulted in a recession. And of course, John Major then took over from Prime Minister Margaret Thatcher, and what was duly elected somewhat surprisingly at the time. And then 1975, those of you who study economics, you'll be familiar with the global oil price shocks. And 1975, we had miners' strikes, all sorts of things going on at the time, and stagflation, so this notion of a stagnant economy and an inflating economy. And at that time, there's a 4-fold increase in oil prices, and obviously the subsequent inflationary pressures which go alongside of that. So interesting just to consider some of the causes of the recessions shown in that chart. Okay, chart 2. With reference to chart 2, compare the recoveries of the advanced economies with those of the emerging and developing economies. Well, I guess it comes as no great surprise that the advanced economies forecasted to recover much more quickly than the emerging and the developing economies. But interesting as well, just to look at the data, comparing with previous recessions, and just to see how far ahead the advanced economies are in 2020, coming out of the 2020 pandemic and recession associated with it, relative to the emerging and developing economies, which did fare much better in previous economic downturns and crises. Now, of course, that is referenced within the article, and the author talks about the lack of monetary and fiscal firepower, and the emerging and developing economies' access to a vaccine as well, which obviously is a great impediment to sort of opening up, and therefore the global economy recovering in emerging and developing economies, not just in the advanced economies as well. When we talk about the firepower, it's just interesting to think about the sums of money which are being pumped into the economies. So the European Central Bank has this pandemic emergency purchase program, whereby they're pumping in 1.85 trillion euro into the European economies. The US Federal Reserve is purchasing $120 billion of Treasury bills per month. And you can see I've put the web links in for the various articles. And of course, the Bank of England currently sitting on a quantitative easing pile of 895 billion at the moment. So there's a lot of firepower being unleashed into these economies, both monetary and fiscal, ultra low monetary policy in terms of interest rates, substantial quantitative easing, very, very loose fiscal policies, which are affordable to an extent, of course, in the advanced economies, not so much in the developing economies. Briefly outline the reasons for the marked difference in the rate of economic recovery between the advanced economies and the emerging and developing economies. Well, again, this ties in very nicely with question 2. The advanced economies, of course, are very substantially ahead with regard to vaccinations. We've seen the commitments from Prime Minister Boris Johnson and President Joe Biden just yesterday with regard to the US pledging 500 million vaccines for the developing world, and the UK 100 million vaccines. So hopefully that will go some way in helping those emerging and indebted economies. They're also obviously heavily indebted, which is problematic for them in terms of being able to unleash any significant fiscal policy response. And the other interesting thing, which is mentioned in this article, and I've put the link to it, is inflation. Of course, it's really dominating a lot of the news headlines at the moment. We've seen the figures for the US this morning. Today's the 11th of June, and the figures just out in the early hours this morning, saying that inflation in the US at the moment shot up to 5%. And if that is a kind of widespread global phenomenon, then the writer in this particular article is suggesting that that might then cause, obviously, the developing nations to have to tighten their policies, monetary and fiscal, simply to get a handle on inflation. And when they tighten their policy, obviously that would involve increasing the base rate or cutting back on government spending or hiking up taxes, or a combination of all of these factors, which would, of course, by default then bring the economies which are already struggling to grow, would put the brakes further on them, indeed might sort of send them into reverse. So an interesting slant on that referenced in that particular article. Question 4, using ADAS diagram, analyse the risks associated with President Biden's highly aggressive monetary and fiscal policies. So I've referenced an article here by Martin Wolf where he talks about the fact that monetary and fiscal policy are quote-unquote wildly expansionary at the moment in the US. Jay Powell, Federal Reserve Chairman, said last August, "We will seek to achieve inflation that averages 2% over time, following periods when inflation has been running below 2%. Appropriate monetary policy will probably aim to achieve inflation moderately above 2% for some time." So what he's saying there is that if inflation has been running below 2%, which it has done for quite a number of years, I think since 2007, 2008, then it would be appropriate to maybe, let's say, see inflation in the US running at about maybe 5% for 2 or 3 years. Now, Milton Friedman would, of course, have something to say about the substantial explosion and the loosening of monetary policy. You'll be familiar with your MV equals PT equation, whereby we talk about the fact that increases in the money supply then lead and feed through into increases in inflation. You will hopefully be familiar with this notion of broad money, an M4 measure, and again, growing substantially in the US, and one would think if we see kind of MV equals PT actually following through in reality, which we haven't seen for a long time, but if we did see that, then again, upside inflationary pressures, one would think. The article also cites this notion of output gaps, so you'll be familiar with the potential output of an economy versus where it's actually operating. And so we can see here in this particular chart that very soon, so sort of 2021 moving into 2022, you can see that the US forecast is that all of their capacity within the economy will have been used up. And again, that is only going to likely to stoke upside inflationary pressures into the economy, and therefore may require some sort of tightening of policy moving forward, because it would suggest that inflationary pressures are certainly going to be on the upside. So a few things for you to think about there. They're not obviously a finite list, but just one or two. And then the final question, given the lag between policy and outcomes, evaluate whether central banks of high-income economies should now begin to tighten their monetary policy. So you can see here, I've just taken a screen grab here of the UK official bank rate, which is at historically low levels, as you'll know, 0.1%, so very, very loose monetary policy. The usual response, of course, would be, if the expectation is that inflation is going to sort of start to run out of control, then the response from the Bank of England would be to tighten monetary policy, and that would mean that the bank rate would be pushed upwards. It's been very, very low for a very, very long time, and one has to think about why that is the case. You know, why has it been so low for such a long time, even though in the last 10-15 years we have still experienced times when inflation has been above that kind of 3% level, which of course would be outside of the Bank of England's plus or minus 1% of 2 target. If we look here at the CPI inflation projection from the Bank of England, we can see that from the fan chart here, we can see the solid line, the darker red, obviously, to the right of the solid line, which illustrates the fan. This is the most likely scenario, and as it fans out and becomes a less deep red colour, becomes lighter in shade, then the Bank of England is, you know, they're saying as a consequence of the lightening of the shade, it's becoming more and more likely that we're going to see rates of maybe 5% or kind of minus 1% deflation. So it looks here, forecasting right through to 2024, that inflation will still be more or less within target. It might, as you can see there, just maybe reach up to 3% sort of back end of 2021 and into the early part of maybe 2022, but generally speaking, it looks as if it'll be on target. So the question is, should there be some sort of policy response here, given that interest rates have this sort of very significant lag? So if you're really worried about inflation being above target, you know, 18 months down the line, really you need to be acting now in order to manage that, because of course the interest rate takes such a long time to feed through into all sorts of aspects of consumer and business spending, be that loans, mortgages, you know, if you're thinking about large airlines, it could be, you know, if they're buying on the futures market, whatever it might be. So there's that lagged effect. And it's really important to think about, you know, are these factors which are driving demand at the moment and pushing inflation up, are they temporary? Are they things that are going to pass through? Are they simply kind of transitory things such as pent-up demand, which will pass? And is it the case that underlying demand is still very weak? And I think most commentators would argue that, yes, a lot of these things are very temporary, kind of supply-side issues in the global economy at the moment. Again, that will eventually pass through. There's a lot of pent-up demand, obviously, being released quickly into the economy. Again, that will pass through. And underlying all of this is an uncertainty in the economy, is rising unemployment levels in the economy. And so underlying AD is still probably quite weak. And so you can see on this chart, which I've taken from the OECD website, we've got here the inflation numbers and the forecasts for the US, and you can see that whilst it is predicted to rise, you know, for approaching 5%, as we move into 2022 and then through into, you know, the latter part of 2022, it's coming back down towards that 2%. The US target, I think, is a maximum of 2, so they want to keep it below 2 ideally. But we can see it's coming back into line with kind of target without too much policy response. So maybe it's the case that, let's just leave things for the time being. I think the other thing to say on that is, of course, that these rates of interest here are exceptionally abnormal. We're not used to seeing such low rates of interest. And actually, it would do no harm to see rates moving back up to, maybe sort of, even if you could get up to maybe 2%, because then that leaves you a little bit of wiggle room if you're operating in the monetary policy, because then when we come to the next recession, you've room to maneuver in terms of loosening your policy. What happens if we leave things as they are and we come to the next recession? Where do central banks go here? Because the interest rate is already almost at zero across, this is globally, it's not just a UK phenomenon. Okay, ladies and gents, so I think that's all I'm going to say on that. Of course, this is not a finite list of things that you can be considering. You may be looking at exchange rates, raw material prices, all sorts of things that you can be considering in your answers to some of these questions. Okay, I'm going to leave it there. Bye for now.